Now here's the myth about trading that I got wrapped up into when I first started. The entry's the most important thing, and it's not. The entry's not the most important thing. Knowing where the price is most likely trying to go to is what's most significant. If we got to a 4-hour chart, okay, do you see this consolidation here? We rallied away, small little consolidation, rallied away again, and then we have climax high, retracement, lower, retracement lower, retracement lower, consolidation inside the consolidation over here, and what would be resting below here? Sell stops, okay, sell side liquidity. So what we have here is a market maker sell model, okay? So what I was using was, last night, I knew we were in this area over here with the expectation of targeting the liquidity resting below the consolidation over here. So I wanted to pair up my orders with what would be existing in the marketplace in the form of sell stops. Why would there be sell stops resting here? Because this is the last intermediate term low prior to this run up that trailed stop losses would be placed right underneath. And they're going to target those individuals with that run.